you could also squeeze the shit out of it. All right, good morning, everyone. Let's get started here. Okay, Friday's session in the States was a real bounce back from the, it was Friday. It was a real bounce back from Thursday's session and almost reversed pretty much the entire day's losses from Thursday. We came back on Friday. It's been quite interesting the last couple weeks, maybe even a few months, and how we just, one day it looks really bad and you think it's the start of something, next day it looks spectacular and you think it's the start of something, and we've just really not been able to gather any sort of momentum either way. I think the U.S. has been more or less in the consolidation phase now, going back for all the way maybe to October, November of last year, and there's been very little in terms of follow through. Obviously, there's been plenty of catalysts. There's been lots of different reasons I think that you thought it could run or either break down, but we just haven't seen anything significant. So I think until we actually get a full-on breakout one way or another, I think you have to sit on your hands, because it gets dangerous trying to go with the momentum as range bound as we have been. We had a couple of significant things that I think have been happening recently. Okay, so we had the big biotech sell-off on Thursday, and then we had it bounce back on Friday. We've had some big things happening in the oil market. The rig count has continued to fall, but we've had a big reversal in terms of the price. I think we've obviously more than likely put in a bottom in oil prices for the time being. We're all the way back up to $60 on light sweet crude. I mean, that's bouncing over 50% off of the lows. We've had a lot of different pieces of news, I think, to kind of digest. We also have ISM numbers, which came out a little bit below expectations. We had consumer confidence numbers that came out more or less right in line. We had jobless claims last week, which were a beat. We have had some wage figures that were a beat. So the numbers have been a little bit mixed, but I mean, I think for the most part, they've still been really solid. And to me, the most important thing that's kind of happening at the moment is in the U.S. 10-year Treasury. I think that, to me, that is shouting something really important to us, and I think that's one that we've got to probably continue to pay the most attention to. The market has been ignoring it largely, but will that continue to happen forever? I mean, history tells you that that's not the case. If we look at what happened in Asia, most all the markets, they were up, although modest. I mean, you can see that there's nothing up even 0.5% on the day, so not a whole lot of leadership. We had PMI numbers out of China, which were a little bit soft, kind of continuing on down that road of giving us worse and worse data. Australia, kind of a bit of a non-event. I mean, we had big reversals in the mining stocks in London on Friday, but not a whole lot out of Australia this morning, probably not as much out of Australia. All right, moving on to our chart of interest on the day. So this is one of the most interesting charts that I saw out over the weekend. This is from Business Insider, and it's showing the ECI wage reports here. This is U.S. government data, so I think pretty reliable. And it looks at the wages back in 2004 and where they were, wage growth was relative to the hiking cycle. You can see there that wage growth is in the dark blue line here. Wage growth was actually falling, but it was at the same level that it is here in the purple line, the same level that it is right now when they started hiking rates in the States. So, I don't think that the wage growth argument, and when we talk about, last week we saw good wage growth numbers out of the States. That argument, I think, comes off the table. That was one of Janet Yellen's main points of interest back when she first took over from Bernanke. So I think that very quickly comes off the table. And if you can see, just from this year, I mean, wage growth is literally on a straight vertical line up. So, right now, obviously, if you've got wage growth, that takes one more little piece of the wait till we hike longer pie off the table. And I think that we've got to, you got to take cognizance of this, and the 10-year Treasury yield is showing you that. We'll get at that chart in just a minute. All right, like we said, we had the Chinese HSBC PMI number was weaker than expected again. We have the German PMI numbers coming out 9:55, PMI coming out for the Eurozone at 10, local PMI at 11, and then we've got U.S. factory orders today at 4. Let's get into some of the maps. First thing that we are going to show is that chart on the U.S. 10-year, and like I said, we did have that big spike up at the very beginning of the year when every data point was coming in hot, and then if you look at the last couple months, data has just been mediocre at best, I think, in the States for the most part. Like we said, we did get a good wage number last week, but other than that, it's been it hasn't been that impressive, and we're very, very quickly coming back toward those highs. We're very quickly moving back, and this is the yield that we're looking at here. Okay, so we're over 210 on the yields again, and we're very quickly moving up toward the 200-day moving average. So, this is, to me, I think, very, very significant. We keep talking about it. It's the most important, I think it continues to be the most important thing to watch. All I think that we need to do is we need to just at least hold up toward these levels. I don't think you have to kind of march in a straight line to higher yields. But holding up here, in the way that we've moved in the last couple of weeks, really starting to signify to me that, or I should say the last week, is starting to mean to me that the market's starting to bet for rate hikes being sooner again, which obviously can create real nerves in global financial markets. Okay, so we talked about that big massive reversal in miners that you saw out of Anglos and Billies and the likes over the weekend, or on Friday's session in London. What happened here was, so we had Vale, which came out and said that they were going to cut iron ore production, and that that they didn't think that miners could keep producing at this level, and you see a bounce in prices. So it's the first of the major miners who's kind of taken the foot off the gas on production, and you had a huge reversal. I mean, I think on Thursday you had Anglos in London, which was down about 3.5%, almost 4% at one point, and then all of a sudden you see it up 5.5% on Friday. So that was, I think, the reason why we got that reversal. That also gave us another leg up after we had already broken out on the copper price. This is the copper price. You can see here making a big breakout. This is real significant too, because you're going through the 200-day here. I think this is hectically significant. So, the mining space is obviously going to trade well today. You got to think that it's going to trade well, but you got to watch it closely as well, because it's how much, whether we're going to close the gap. Every time that London's closed, we can. It's very often that we see a squeeze. Does that happen again today? So just watch these closely. I think one of the ones obviously to watch would be Billiton. All of the mining stocks would be to watch. Billiton, I think, is just kind of it had been consolidating above this flag that it had broken out of for the last week. And today, I think most likely gets up through the 200-day moving average, which is at just south of 291. I think that this is big close equivalent in London at 292.80. So we'll probably get up at least close to that level somewhere. And I think breaking up above, highs of the year at 295 would also be significant. So let's just watch it over the level of the next couple of sessions. Pushing above those numbers, I think, would be very significant. All right, we'll look at Sasol as well. Now, we talked about this before, but I think it's worth reiterating. We came down and we closed just above this 480 level on Thursday. So we made a nice breakout here above 480, which you can see, it's the most easily seen support resistance level here. The fact, we come down to retest this thing. If we don't drop 480 over the next couple sessions, I can real easily see this thing, getting up here, at least filling the gap at 505. And to the 200-day moving average, and I think that's probably what's the most likely scenario anyway. All right, the last one we'll show today is Remgro. So Remgro has been really underperforming our market, which has been incredibly strong for quite a while now. So we came into major support here at 260 on Wednesday. We actually dropped it intraday for a little bit. We came up, nice reversal into the close. Closed more or less at the same price we opened at the day, and then Friday we pushed up a little bit. To me, I think that's a really solid hold. This thing, I don't see why it should be underperforming the market to the extent it is. I think big discount maybe to NAV again, and this potentially, if we could break above maybe a 270 level, we could be breaking out of a really nice descending triangle formation here. So anyway, that's all I got for today, guys. Good luck out there.